If you still think mutual funds are just large cap or ELSS, you're stuck in 2015. In 2025, a new wave of mutual funds is changing the way India invests, quietly, efficiently, and often more profitably. You've probably heard of index funds. But what if I told you there are mutual funds that rebalance themselves using artificial intelligence, or others that lock in your returns almost like an FD, but with better tax efficiency? In this video, I'll walk you through the newest and most powerful mutual fund categories trending right now. By the end of this video, you'll be 5 years ahead of 90% of mutual fund investors in India. Passive multi-asset funds. Imagine a single mutual fund that invests across stocks, bonds, and gold, and automatically shifts weight between them based on market trends. ICICI Prudential Multi-Asset Fund has consistently delivered 10–12% annualized returns over 5 years with less volatility than pure equity funds. Perfect for 5–7 year horizons. Smart beta funds. Traditional index funds follow market cap. But what if we could track factors like momentum, low volatility, or value instead? Funds like Nippon India Nifty Alpha. Low volatility 30 have delivered 11–14% returns, blending passive cost with active style intelligence. Target maturity debt funds. Want the predictability of an FD with better tax treatment? They invest in high-quality government and PSU bonds that mature on specific dates. Bharat Bond ETF April 2033 offers 6.87.3% returns with indexation benefits. Buy and hold till maturity, no rebalancing needed. Global mutual funds. Invest in Apple, Microsoft, or Amazon from India through international mutual funds like Motilal Oswal Nasdaq 100. They've delivered 8–12% returns with currency gains adding extra returns. Uses 10–15% tactical exposure with annual rebalancing. ESG funds. Invest for returns and a better planet. These funds invest only in companies with strong environmental and ethical records. SBI Magnum ESG Fund has delivered 9–13% CAGR over 3 years while staying aligned with sustainable values. Use for 7+ year horizons. Silver ETFs, the rising star in commodity investing. Silver is in high demand across electronics, solar, and batteries. ICICI Silver ETF offers 6–10% CAGR, but with higher volatility than gold. Best for 3–5 year tactical bets, cap under 10% of portfolio. Children's gift funds like HDFC. Children's gift fund are structured for long-term compounding, automatically shifting allocation as the child grows older. Returns around 9–11% CAGR with exit restrictions for discipline. Perfect for 10–15 year education planning horizons. Quant funds. Mutual funds that rebalance using artificial intelligence and machine learning algorithms to select and weight portfolios dynamically. Tata Quant Fund has delivered 10–15% CAGR in early phases. The fund's AI handles rebalancing internally, removing human bias. Low-cost index funds, UTI. Nifty 50. Index fund simply tracks the Nifty with minimal fees, consistently delivering 10–12% CAGR over long term. Let's recap. Multi-asset funds give diversification. Smart beta offers intelligent investing. TMFs provide predictable returns, global and ESG funds bring tactical diversification, and index funds offer long-term wealth creation. Each fund serves a unique purpose. The secret is knowing which ones to mix based on your goals and time horizon. If you found this useful, smash that like button and subscribe. Drop your questions in the comments. See you in the next one.